right, hello and welcome to another Expert Inside interview. My name is John Golden from SalesPOP, online sales magazine and pipeline or CRM, joining you as usual from a sunny San Diego. And today I'm delighted to be joined by Mark Myers, who is in an equally sunny, if not more so, North Florida. How are you doing, Mark?
I'm doing great, John. Thanks for having me. Excited about the conversation.
Yeah. And Mark actually spent some time here because Mark is a former Marine Corps Sergeant from Bravo Company, 4th Marine Division. So we thank you for your service, who brings the same discipline, tenacity, and unwavering integrity used serving his country to the world of advanced tax planning. And believe you me, given the tax codes here, you probably need somebody with a military background to attack it.
That's
Yeah. So 20 years of successful business operations, high-level consulting experience. You founded TaxWise Partners more than a decade ago. And as a tax-saving architect, you've helped 500 plus high-income earners and business owners permanently reduce their annual tax bill, wait for this, by 30 to 60% without even replacing their CPAs or financial advisors. So that's amazing. All right, and that's what we're going to talk about today. So why is it? I mean, you say like about 90% of businesses are overpaying taxes. I mean, that's a startling statistic. I mean, why is it? I mean, given that they all have like accountants and CPAs and probably tax advisors, how is it that they're still that there's the majority, that huge a majority, is still overpaying?
Well, John, I think it's really a metric of, I like to use this analogy. Most individuals that are high income earners or even small to medium sized businesses, they have a CPA and they look at that CPA as the end all be all,
Hmm.
right? And 9 times out of 10, a CPA is just doing their best to keep up with tracking and recording and filing.
Yeah.
They don't have the bandwidth and maybe they don't have the desire to do forward-looking planning, and they definitively don't have the desire or the time to look at the 75,000 pages of tax code and see what is possible, right? Because there's a lot of possibilities there. I always like to say there's a lot of coupons in the tax code. The IRS just doesn't send out a flyer like Trader Joe's.
Right.
You got to go find them yourself, and that's where we come in. But I would say that that's the case. It's almost like if you went to a general practitioner for
Hmm.
medicine and you had this huge headache and it was like a tumor in your frontal lobe, and they're like, oh, you're just going to have to pay, that's just the price you pay for the tumor, don't worry about it, we'll just have to deal with it. Well, that would be horrible, right? Because your general practitioner would say go to a neurologist.
Yep.
But instead the tax professional says you just make a lot of money, you got to deal with the pain of paying the tax, instead of saying, well, we should go to a specialist. Why? Because most of the other specialists do the tax prep and return, so they're never going to refer them out. That's why we would do what we do. We don't step on their toes. We don't do anything that they do. We just add that extra layer of value. So long answer to a
No. That makes total sense, because if you think about it, small businesses and high net worth individuals, you're off. You're so busy doing what you're doing, and as I said, and you then, like you said, then tax time comes around and you're thinking, okay, CPA, whatever, they've got a handle on all of that, they do it, whatever, and then you move on. But it's not something you're really thinking about all year round.
tax planning is done in looking forward, not in reverse.
Hmm.
And the earlier you start thinking about it, the better. Now, do we have opportunities to give people refunds for up to 3 years in the past? We do, but you still have to look forward to do it. But at the end of the day, you know, uh, we always say, look at your tax burden like a profit center.
Mm.
Look, most business owners are trying to reduce expenses. They're trying to drive revenue, right? Because they want more income.
Yep.
Well, 30 to 50% of your, in California, 50% of your income, 30% of your net income is going out the door from a business partner that doesn't really help you. Well, that's an area that I would say focus on reduction of cost.
Yeah,
So you can
absolutely.
create significantly more income if you just reduce that burden by 20%, but we can cut it down by sometimes 70%. So
Yeah.
uh,
Yeah. Well, in California, it includes your firstborn normally as well. So.
that's right.
So how is your Marine Corps background? How has that helped you with this? I mean, because you talk about applying battlefield discipline to this. How has that influenced your approach?
I think it really has it has a lot to do with resourcefulness. As a Marine, you have to be resourceful. You have to be, what resources, what tools do you have, and what can you do with them? Um, so I think that, and then discipline and also courage, right? Because here's the thing, a lot of the strategies that we implement, it's not something that it's not like a mortgage interest deduction or a 401k tuck away. It's stuff that, people are like, wow, I didn't even realize you could do that. So there's an extra layer of planning around it, but it's just not going to be the beaten path for most people. It's a little bit, but it's inside the code, it's inside the framework, but it's not inside the box. I say it's
Mm.
outside of the box, but inside the code.
Right, right. So tell me a little bit about your framework, like especially like treating tax liability as investment.
Yeah, so we want to look at, just like anything, particularly if you're going to give yourself a return, you're generally going to have to initiate and have some kind of spend. So our goal at TaxWise Partners is, when we evaluate and look at the fact pattern of whoever it might be, because it might be a high income earning W-2 executive, it might
Mm.
be someone that's doesn't have a lot of income every year, but they just sold a property that they inherited or they've
Right.
held for years, and they're going to have a few hundred thousand to a few million or to many, many millions of dollars of capital gain. So we're looking at, well, what kind of planning can you do to legally defer the tax, legally avoid the tax, or possibly offset it with some other type of deduction or depreciation? Like, for example, we always want people to spend $1, but we can show them how to save substantially more than $1 in tax,
Mm.
usually in the first year. So, hey, it's the question is, hey, you've got $100 tax bill. I'm just using that for easy
Sure.
math. What if you could spend $50 to not have to pay the $100 in tax? Well, that's a good deal, right?
Mm.
$50, you're either going to pay the authorities $100, or you could purchase this asset for $50 and it offsets your $100 tax bill. I'll take that all day long.
Yeah, no, no, absolutely, absolutely. And I guess part of what you're saying then is for to help people kind of reorient their approach to the IRS. Like instead of being on the defensive, it's like you're being on the offensive a little bit more. You're planning ahead. You're taking, you're really figuring out how you can make it work to your advantage. Because let's face it, most people are defensive. They're just like, oh goodness, I hope I don't owe money.
Exactly.
And if I do, I hope it's not more than I expect.
I've heard the someone say, it was actually a former client, and they said, I usually just brace for impact, right? I talk to my CPA and brace for impact.
Yeah, no, absolutely. So how do you help people reorient that thinking, like to say, okay, you need to go on the offensive as opposed to look at the IRS and just be scared and defensive all the time?
I think it really has to do with their disdain for taxes. If they really feel like, man, I'm paying a lot more than I should, and I know other people pay less, but I can't figure out how they do it because my CPA says I'm doing everything I can, which is fine. We're never going to make the CPA look bad. We just want to
Yeah,
be.
yeah.
That's one of the reasons why a lot of CPAs like to work with us, because we just add value. But at the end of the day, we want people to think about, well, what is the federal government? How do they provide incentive? Because if you can take advantage of the incentive that they provide, you're basically doing what they want you to do, but you're actually being wise about it. So, for example, for years and years and years, clean energy has been a big deal for
Hmm.
government. Now, the one big beautiful bill kind of changed that, but just note we have ways to continue benefiting from clean
Right.
energy for the next 5 years. But let's just say, for the most part, if you had a solar project that was originated, you could get up to 50% tax credits. And a tax credit is not like depreciation or deduction. If you have a $1 tax credit, it offsets $1 of federal
Yeah.
tax. That's pretty
Hmm.
powerful. So now you start thinking about these things, because people are like, well, how does that benefit me? Well, what if you owned a small solar business? What if it wasn't really difficult to manage and own a small solar business because we have resources that make it easy for you?
Hmm.
Well, now you can you can originate solar projects that produce clean energy, which is what the federal government wants. And you can get a whole bunch of tax credit and a whole bunch of depreciation in a very short period of time. And oh, by the way, just like real estate, you buy a duplex, you might not pay all cash. You might put a certain amount
Right.
down, and you take a loan. Well, guess what? Your tenant pays rent, and that covers your loan, and you still have positive cash flow. But here's the thing with solar. We show people that they can put $1 into their solar business, get $1.50 of tax savings, and the cash flow for the next 40 years is just free money for them.
Mm,
So like that's kind of the like because you got to think outside of the box. So those are
yeah.
the things that we help people do.
Yeah. So also like what are some of the investment strategy? That's one that you just mentioned there, which is fantastic. Are there other investment strategies like that?
Yeah. So one of the things that's super simple that people kind of overlook is charitable strategies. And the reason why they overlook them is because obviously everybody's going to say, great, Mark, I've donated to my favorite philanthropy
Yeah.
before, the Red Cross, the church, my local church. And last time I checked, even in California, when I gave that organization $1, I saved 50 cents. But if I do
Mhm.
my math right, I'm still 50 cents short in my bank account.
Yeah. 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 Yeah.
But here's the thing, if you donate to a cause that you love, they get a whole dollar. You would have given them $1 anyways. It only costs you 50 cents to give them $1. Well, that makes sense. But here's where we're going with charitable donations. Well, you don't, for 120 years, you don't have to donate cash. You can donate a non-cash asset to a charitable organization so long as they use that asset for their philanthropic
Mhm.
efforts. So it has to be in alignment with what they do. But let's just think about this. Well, if you can get creative and you know how to access resources at discounts, because there are, believe it or not, there are a lot of owners of assets out there that are willing to sell them for substantially less than their currently appraised value. So what if you could buy an asset that's worth $1 for 20 cents, 25
Mhm.
cents?
Right.
Okay. Well, if you turn around and donate that asset, you have to follow the rules. There's some rules that are around that. But if you donate that asset, well, in California, if you have $1 asset that's appraised value as $1, you get a 50-cent tax savings. But you only pay 20 or 25 cents for that.
Right. So now you're making now, yeah, so now you're making money.
So literally, we're always trying to make sure that whatever that our clients are purchasing, they're getting a larger tax savings than their purchase. And it all has to do with maybe they're going to be in turnkey solar, maybe they're going to be in short-term rentals and do cost segregation. Maybe they're going to purchase an asset at a discount and donate it. Maybe they're going to join a partnership. You can join a partnership, and that part of the benefits of the partnership is you get a negative K1, but
Mm.
your negative K1 is larger than your capital contribution. So there's a lot of things that you can do. Now there's risk involved in all these
Well,
things, but
sure, sure.
essentially your reward is not dependent on the S&P 500's performance. It's
Yeah.
literally you will get this benefit because your tax bracket is so high. You're going to get it. The
Mhm.
benefit is theirs. Now you just have to execute the action. Like you do have to own the solar business. So now you're responsible for these solar panels
Right.
producing energy for whoever you're leasing the energy to. But guess what? You're giving energy to someone that's got to buy it anyways from PG&E or SoCal Con Edison, and they're going to pay more. So wouldn't they rather pay you less for their
Mhm.
energy? You got a pretty good commodity that you're
Yeah.
selling.
Yeah. No, they're gonna pay substantially more, especially here. The electricity cost is completely off the charts. Um, so, um, so how when you start build this business, how do you approach, working with the CPAs and the existing tax professionals? Why are they okay working with you as opposed to like as you said, seeing you as a threat?
John, I really think it's because we really focus on them understanding that we are a value add.
Hmm.
We do not want to ever think that their client is like, we're not usurping them. We're not like
Yeah.
they're our clients. Like they're always the CPA's client. We're just working in tandem with that CPA or the registered investment advisor or the
Yeah.
enrolled agent. Um, so we're just creating more value, and hopefully it just makes, because here's the thing: what a lot of CPAs are realizing is that if they're not going to start doing this, these other groups are, and they're going to lose their clients.
Mm.
So it's actually a retention mechanism. It can also be a revenue share because we make money when we do these things and we can share it so it can immediately add revenue to the CPA firm. And
Right.
the other side is, they generally start attracting higher net worth clients because guess what? Birds of a feather flock together.
Yeah.
Somebody says to their friend, hey, my CPA introduced us to this strategic partner of theirs and they do, and the person's like, well, who's your CPA? And they say,
Yeah.
go. So now they are attracting new clients that they want to work with, right? So it's really a value add for everyone except the IRS, but they're
Right.
overcharging anyways. We're saying, we don't pay retail, pay wholesale, right? You don't have to
Mm.
pay retail.
Yeah, yeah. No, absolutely. Yeah. And tell me the other one that I think, so when people have a business or they're going to exit a business or sell their business or whatever, it's a process. Usually, you have to build up to selling and to exiting or whatever. And it tends to be a time of, very busy, very caught up and all of that. So doing the tax planning for the exit or post exit for how are you, that seems to be something that a lot of people kind of leave till post exit, right? And that's a big mistake.
For sure. I would say that if you're going to sell an asset and you're going to have a considerable capital gain, come to us or talk to your CPA, and hopefully your CPA knows about us. But if not, come to us directly and we'll talk to your CPA. Like we're okay with doing it
Mhm.
in reverse.
Right.
Um, the CPA doesn't make the decisions, right? It should be you. Like,
Hmm.
um, so that being said, usually if we have 3 months or more prior to the sale, we can structure that sale such that you don't take assignment of income or constructive receipt of the income. And if you don't take constructive receipt of the income, there's no tax bill to you. So
Mm.
this other entity might take constructive receipt, but the way we structure that entity is that they acquired the asset at the same price as the purchase. So
Right.
there's no net gain to that structure. And now you control all the money in that asset and you put it to work. So if there's no net gain, you didn't lose 33 to 37%. So if you're a California citizen, you know
Hmm.
that long-term capital gain is 20% plus 3.8% plus 13.3%. So now you have 33 to 37% all there to reinvest. And now you sip the money out of that entity over time to reduce your tax burden as opposed to gargling down that tax burden because you sold this big asset at once and you got hit with these high
Right.
brackets. Or there's other strategies where you can actually, believe it or not, the deferral becomes elimination if you structure it correctly. But that would be ideal. If you have some time before, we can show you how to reposition the asset prior to the sale. But let's just say they didn't know that. After the sale, they're saying, oops, what should I have done? We say, well, you should have talked to us 3 months before, but there's other ways to reduce the tax on your capital gain even after the sale, so long as it's before December 31st, right? Because if
Right.
it's a calendar year, we have until December 31st to do something about it.
Yeah. So what should you be doing? I mean, even before, 3 months, what are things you should be thinking about as if you're an owner or you have an ownership stake in a business that's going to be sold maybe in the next year or two?
Well, you definitely want to get with a good M&A group. You want to make sure that your procedures are very duplicatable so that acquiring company
Hmm.
can just plug in. You want to get rid of all that additional fluff expense, right? That you might have had before because you were taking the income, but maybe the year that you're going to sell, you want the income to be as strong as possible. So
Hmm.
your expenses kind of get reduced.
Yep.
So that way you're as healthy as possible on your margins, your EBITDA margins, and hopefully you'll get a great multiplier.
Hmm.
Um, but that would be, you want to do that. You start thinking about that a couple years before, and then the year that you're really serious about selling, you're dialing back your expenses, creating all the efficiencies, and then of course, as I mentioned before, don't just sell it and take that money in your name or not have a plan as to how you're going to offset that income after you sell.
Right, right. So absolutely. So great piece of advice there, and I think that's one thing to just underline for anybody watching and listening is that idea of like in advance go to somebody like Mark and start planning for your exit. So I mean, as you said, you can do it afterwards, but it's obviously not as efficient as doing it in advance and figuring out all your different options. So if you had one piece of advice to business owners or high net worth people or people going forward, what would it be?
It would be, and I said it a little bit before, but this is the
Mhm.
one piece: treat your tax liability like a profit center. And if you do that, think about it. If you just reduced your taxes by 30% per year and your net gain was 20% of that 30%,
Mhm.
how much further ahead could you get in your retirement planning or your recapitalization of your business, because you just got that much more profit that before you were just stroking the check because you thought you just had
Yep.
to pay. So that
Mhm.
would be my biggest, like, slow down and focus on cost reduction, particularly to taxes. Maybe in the other areas of business, you just want to drive revenue, drive revenue, drive
Sure.
revenue. But in this area, it makes sense to slow down to reduce the burn.
Yeah, no, absolutely, and optimize. And as you said, I mean, also if you're reducing expense and stuff, it normally, hopefully, means you're optimizing your business too. So you're making it an even better acquisition target.
100%.
Yeah.
Absolutely.
Yeah, because let's face it, I mean, I've seen acquisitions in the past, when they acquire like a bloated organizations, and the amount of money that's and time that's wasted in just trying to get the business like eh, get the business to a point where it can be integrated or it can operate, in the new ownership structure. But yeah, I think it's all about making it as simple as possible.
Agreed.
Yeah.
Agreed.
Well, fantastic, Mark's. It's great insights. Like, all of Mark's information to be below this video. But before we go, please do remind people about what you do.
Oh, absolutely. I would say that we reduce people's taxes by, on average, more than 50% without removing their CPA, without, getting in the way of their investment advisor. We work alongside them. And our goal is for every dollar that we recommend you spend, you're going to save more than $1 in taxes in the very first year.
Fantastic. Well, listen, thanks again, Mark. Thank you for watching and listening. I'll see you all again soon. Thank you.